There is a moment quiet, unremarkable to the untrained eye, that separates those who build generational wealth from those who spend their lives chasing it. It is not the moment a business is launched. It is not the moment a stock is purchased. It is not even the moment an inheritance is received. It is the moment a person learns to read a loan document differently from everyone else in the room. The man who understands compound interest earns it. The man who doesn't pays it. Attributed to Albert Einstein. For most people, debt is a trap. A credit card that grows faster than you can pay it. A car loan that outlasts the car. A mortgage that consumes 30 years of income. A student loan that follows you into middle age. For old money, for the Rockefellers, the Rothschilds, the Astors, the Vanderbilts, and the quiet dynasties whose names you will never read in a newspaper, debt is something else entirely. Debt, in their hands, is a lever, and today we are going to pull that lever apart mechanism by mechanism and show you exactly how it works, and why the financial system you were taught to fear was actually designed in many ways to reward people who understood this secret. This is not a video about getting rich quick. This is not a video about cryptocurrency or stock tips. This is a deep, unflinching education in the financial philosophy of people who have held wealth real, compounding, generational wealth for not years, but centuries. Stay with us, because by the end of this, you will never look at a debt instrument the same way again. The two worlds of debt. To understand how old money uses debt, you first need to understand something that the financial industry spends enormous energy obscuring. There are two entirely different financial realities operating simultaneously in the modern world. In the first reality, the one most people inhabit, debt is sold to you as access. Access to a car you cannot afford. Access to a university education. Access to a home. Access to a holiday, a television, a sofa, a mobile phone. In this reality, debt is consumption financing. You borrow money to buy things that either lose value immediately or provide no financial return whatsoever. The interest on this debt flows upward to banks, to credit card companies, to lenders, and it does so reliably, predictably, for decades. In the second reality, the one inhabited by old money families and the financially sophisticated, debt is used in precisely the opposite way. Debt is not used to consume. Debt is used to acquire. Specifically, it is used to acquire assets, things that generate income, appreciate in value, or provide leverage over other assets. In this reality, the interest paid on debt is not a loss. It is frequently a deductible business expense. It is a cost of capital that is more than offset by the returns generated by what that capital purchased. Let me give you the starkest possible illustration of this difference. A middle-class family borrows $30,000 at 24% APR on credit cards to pay for a kitchen renovation, a family holiday, and various consumer purchases. Over 5 years, they pay back $46,000, having surrendered $16,000 in interest on things that provided zero financial return. Their net worth decreases. Meanwhile, a wealthy family uses a $30,000 line of credit secured against their existing property at 4% interest to invest in a small commercial property that generates $3,000 per year in rental income. Over 5 years, their interest cost is approximately $6,000. Their rental income over that period is $15,000. The property has also appreciated. Their net worth increases. Same dollar amount borrowed. Wildly different outcomes. The difference is not intelligence. The difference is not luck. The difference is category of debt and the knowledge of which category to choose. Old money understands this distinction at a bone-deep level. It is taught sometimes explicitly, more often through osmosis across generations. It is the invisible curriculum of wealth, a brief history of aristocratic debt. To truly understand how old money thinks about debt, we need to go back not decades but centuries. The relationship between aristocracy and debt is as old as aristocracy itself, and the history is far more nuanced than the popular narrative of reckless nobles squandering fortunes on gambling and excess, though that certainly happened too. The story begins in medieval Europe, where the Catholic Church prohibited the charging of interest, a practice called usury, as a sin. This created an extraordinary situation. The nobility needed capital to finance wars, expand estates, and conduct trade, but could not openly borrow from Christians at interest. The solution was the Jewish moneylender, a figure both despised and utterly indispensable to the functioning of medieval economies. Kings, dukes, and earls relied on these financiers for the capital that powered their ambitions. It was an uncomfortable dependency that shaped the politics of an entire era. But something fascinating happened in the Renaissance, particularly in the city-states of northern Italy, Florence, Venice, Genoa. Merchant families, most famously the Medici, began to develop sophisticated banking instruments that technically circumvented the usury prohibition while achieving the same economic effect. The letter of credit, the bill of exchange, the deposit account. These instruments allowed wealth to move across borders and across time in ways that had never before been possible. And the families who mastered these instruments, the Medici, the Fuggers of Augsburg, the Bardi, became the true power behind the thrones of Europe. Pope Leo X was a Medici. The Holy Roman Emperor, Charles V, was financed largely by Jakob Fugger, a man so powerful that when the emperor expressed reluctance to repay his debts, Fugger wrote back, with a reminder that he had financed Charles's very election, and that without his support, the emperor would not have won the crown. Read that again. A banker reminded an emperor that he owned him. This is the first lesson of old money and debt. At sufficient scale, the lender holds power over the borrower, and the sophisticated families of history learn to be on the lending side of that equation whenever possible. Moving forward to the 18th and 19th century Britain, we see a different but equally instructive dynamic. The landed aristocracy of England operated on a system of entail and mortgage that modern observers find baffling until you understand the logic. A great estate, say, 10,000 acres in Derbyshire, could not simply be sold by the current earl. It was entailed, meaning it was legally locked into the family line and must pass to the next heir intact. The earl could not liquidate his wealth. He could only borrow against it. So the aristocracy became extraordinarily sophisticated users of mortgage debt. They borrowed against the estate to finance improvements, political careers, London townhouses, and yes, sometimes gambling debts. They borrowed from insurance companies, from private banks, from wealthy merchant families eager to secure their loans against English land. Was this always wise? No. Many great estates were eventually sold when the debt became unsustainable, a process that accelerated dramatically after the First World War when death duties, estate taxes, compounded the problem. But many others navigated these waters masterfully for centuries, using debt as a bridge between assets that were illiquid but enormously valuable, and the cash flow needed to maintain position and influence. The Duke of Westminster's family, now one of the wealthiest aristocratic dynasties in the world, used precisely this model. The Grosvenor estate's vast land holdings in Mayfair and Belgravia were never sold. They were developed, leased, and mortgaged to generate the capital needed to maintain and expand the family's position. Today, those properties are worth tens of billions of pounds. They were bought with debt, developed with debt, and held through debt for over 300 years. The Rockefeller model, the master class. No discussion of old money and debt is complete without an extended examination of the Rockefeller family, arguably the most studied dynasty in American history when it comes to wealth preservation and financial sophistication. John D. Rockefeller Sr. built Standard Oil into the most powerful monopoly in American history, accumulating a fortune that at its peak represented approximately 1.5% of the entire U.S. GDP. In today's money, that would place him comfortably as the richest person in human history. But what is less discussed and far more instructive for our purposes is not how he built his fortune, but how his family kept it. Because here is the extraordinary thing. The Rockefeller family fortune has not diminished across 6 generations. If anything, its total impact through foundations, through investment vehicles, through real estate has compounded. While the individual shares have naturally diluted as the family has grown, the family's collective financial and institutional power remains formidable well over a century after its founding. How? Through a set of interlocking financial mechanisms, of which debt leverage is a central pillar. Let us examine the Rockefeller Center as a case study in debt leverage that has never been surpassed for sheer elegance. In the 1920s, John D. Rockefeller Jr., the founder's son, had recently inherited a colossal fortune. He was also a man of serious philanthropic and civic ambition. When the Metropolitan Opera approached him about co-developing a large Midtown Manhattan site, the timing seemed perfect. Then the stock market crashed in 1929. The Metropolitan Opera pulled out. Rockefeller was left with a 99-year lease on 3 city blocks of Manhattan's most prime real estate and an obligation to develop it. He had 2 choices. He could liquidate other assets to fund the development, outright selling stocks, bonds, or other real estate in the teeth of the Depression. Or he could use debt. He chose debt, and not just any debt. He orchestrated one of the most sophisticated construction financing arrangements of the 20th century, borrowing hundreds of millions of dollars in Depression-era dollars. Remember to build what would become Rockefeller Center. Critics called it reckless. Economists doubted. The press mocked. But Rockefeller understood something they did not. He was not building a building. He was building a cash-generating machine, one that would produce rental income for decades, appreciate in value indefinitely, and against which further borrowing could be secured at advantageous terms. The debt was not a burden. It was the tool that created the asset. By the time the Rockefeller family eventually sold a stake in Rockefeller Center in the 1980s, the complex had generated billions in income, had appreciated to a value many multiples of its construction cost, and had served as the anchor for some of the most favorable corporate relationships and tax arrangements in American real estate history. The debt that financed it had been serviced, retired, and replaced many times over. What remained was an asset of staggering value, purchased, in essence, with borrowed money deployed with extraordinary precision. This is the Rockefeller model, and it has been replicated in varying forms by every major old money dynasty in the world. The mechanism, how the lever actually works. Now let us move from history to mechanics. because you deserve to understand not just that old money uses debt as a lever, but precisely how the mechanism functions. The concept at the heart of everything is called OPM, other people's money. The fundamental insight is this: if you can borrow money at a lower rate than the return you generate by deploying that money, you profit from the difference, and you do so using capital you never owned in the first place. Let us walk through this with a clean example. You have $1 million in assets. You could invest all $1 million and hope to earn, say, 8%, giving you an $80,000 annual return. Or you could use your $1 million as collateral to borrow an additional $3 million at 4% interest, giving you $4 million to invest. At the same 8% return, you now earn $320,000. You pay $120,000 in interest on the loan. Your net return is $200,000 on assets you originally owned worth $1 million. That is a 20% return on your own capital, achieved by using $3 million of someone else's money. This is leverage. This is the lever. Now, and this is critical. Leverage amplifies in both directions. If your investment returns fall below 4%, you are losing money. If the asset value collapses, your losses are magnified by exactly the same mechanism that magnified your gains. This is why unsophisticated use of leverage destroys wealth as surely as sophisticated use creates it. Old money families understand this viscerally. They have watched other dynasties, nouveau riche industrialists, overextended aristocrats, reckless speculators be wiped out by leverage in downturns. They have a long institutional memory of what uncontrolled debt does. So, old money uses leverage, but it uses it within a rigorous framework of rules. Let us examine those rules. Rule 1. Only borrow to acquire income-producing assets. The first and most inviolable rule of old money debt is this: debt is only permissible when the asset it purchases generates income that exceeds the cost of servicing the debt. Real estate that produces rental income, businesses that generate profit, agricultural land that produces harvests, loans to other businesses at interest, equity stakes that pay dividends, not holidays, not cars, not clothes, not renovations that cannot be rented out. This sounds obvious. It is not obvious to most people because the consumer debt industry has spent the better part of a century training people to feel comfortable borrowing for consumption, to normalize it, to make a $60,000 car loan feel like a reasonable middle-class decision. Old money views consumer debt that finances consumption rather than acquisition with something approaching revulsion. Not moral revulsion, but financial revulsion. It is simply not something that rational actors do if they understand how money works. The Duke of Devonshire does not put holidays on a credit card. The Rothschild family did not build their empire financing personal consumption. From the earliest generations, the discipline is clear. Debt is for assets, never for lifestyle. Rule 2. Match the debt to the asset. The second rule is structural. The duration of the debt must be matched to the nature of the asset it finances. Long-term illiquid assets, real estate, forests, agricultural land, infrastructure should be financed with long-term debt. Short-term liquid assets, inventory, receivables, working capital with short-term debt. This sounds like basic finance. And it is. But the failure to follow it has destroyed more businesses and families than almost any other single error. When short-term debt is used to finance long-term assets, you create a catastrophic mismatch. If the short-term debt must be rolled over renewed at the end of its term, at a moment when credit markets are tight, you may be unable to refinance. You are forced to sell the long-term asset in a depressed market to repay the short-term loan. You crystallize a loss that would have recovered given time. This is exactly what happened to thousands of American real estate investors in 2008. They had financed long-term properties with short-term, variable-rate mortgages. When rates reset and credit froze, they could not refinance. They were forced to sell into a collapsing market. Generational wealth evaporated in months. Old money does not make this mistake. The Grosvenor estate does not finance a Mayfair building with a one-year revolving credit facility. The 99-year lease gets 30-year fixed-rate debt. The asset and the liability are matched in duration, and the family can wait out any market cycle without being forced to sell. Patient capital is the phrase old money uses. Debt structured to allow patience. Rule 3. Keep the loan-to-value ratio conservative. The third rule concerns the size of the debt relative to the asset it finances, what finance professionals call the loan-to-value ratio, or LTV. In boom markets, lenders will happily provide debt at 90%, 95%, or even 100% of an asset's value. This means the buyer has virtually no equity cushion. A 10% fall in asset value wipes out the buyer's entire equity and leaves them in negative territory. Old money families, across generations, have consistently maintained conservative LTV ratios, typically in the range of 40 to 60% for real estate, lower for other assets. Why? Because the equity cushion is what allows them to survive downturns, to hold assets through cycles, to avoid forced selling. It is what gives them the option value of patience, the ability to wait for the market to recover rather than being forced to crystallize a loss. When the Vanderbilt family was building their railroad empire, Cornelius Vanderbilt was careful to ensure that the Central Railroad's assets were never over-leveraged relative to their underlying value. He could see the balance sheet of his competitors. Men who had borrowed aggressively in the boom, whose assets were worth less than their debts in a downturn. They were wiped out. He survived and expanded. Conservative leverage is not timidity. It is durability. And durability is the prerequisite for generational wealth. Rule 4. Use debt to buy time, not just assets. Here is a concept that most people never encounter, but that old money understands at a profound level. Sometimes, the most valuable thing debt buys is not an asset, but time. Consider the following scenario. An estate produces farmland income of $200,000 per year. An unexpected expense, a lawsuit, a death duty, a failed harvest, creates a short-term cash need of $500,000. Without the ability to borrow, the family must sell land, permanently surrendering an asset that generates $50,000 per year in perpetuity in order to meet a one-time need. With access to debt, they borrow $500,000 at 5%, pay $25,000 in annual interest, retire the loan over 5 years from ongoing income, and keep the land, which continues to generate $50,000 per year forever. The cost of borrowing is $25,000 per year for 5 years, $125,000 total. The cost of selling would have been $50,000 per year forever. Debt bought time. Time preserved the asset. The asset preserved the family's income indefinitely. This is why old money families invest so heavily in maintaining banking relationships and lines of credit, even when they do not need them. The availability of debt, the ability to borrow on short notice at favorable terms, is a form of insurance. it prevents the catastrophic forced sale. Lord Rothschild is famously reputed to have said that the time to buy is when there is blood in the streets, including, he added, when it is your own. What he meant was that access to capital at moments of crisis is what separates the survivors from the casualties. Old money maintains that access at all times for exactly this reason. The tax architecture of debt. We have been talking about debt as a financial lever, but there is another dimension to this story that is, if anything, even more powerful and even less widely understood. Debt used correctly is one of the most effective tax management tools in existence. Let us explain this carefully. In most Western tax jurisdictions, when you sell an appreciated asset, a share of stock that has doubled in value, a property that has tripled, you pay capital gains tax on the profit. In the United States, depending on the holding period and your tax bracket, this can be 15 to 20% of the gain, plus state taxes. In the UK, it can be up to 28% for property. In many European countries, similar rates apply. This creates a punishing dynamic for wealth holders. The more successful you are, the more tax you pay every time you realize a gain. Old money's solution? Don't realize the gain. Borrow against it instead. Here is how this works in practice. You own $10 million worth of Apple stock that you purchased for $1 million. You have a $9 million gain on paper. If you sell, you owe perhaps $1,800,000 in capital gains tax, leaving you with $8,200,000 to reinvest. Instead, you go to your private bank or your prime brokerage and borrow $5 million against your Apple stock as collateral at an interest rate of, say, 2 to 3%. You now have $5 million in cash to deploy, and you have paid zero tax. You still own the Apple stock. You still benefit if it continues to rise. You have accessed the wealth embedded in your position without triggering the tax liability. You use the $5 million to purchase an apartment building, generating $300,000 per year in rent, a 6% yield. The interest on your margin loan costs you $100,000 to $150,000 per year. Your net annual return from the transaction is $150,000 to $200,000, and you have still paid no capital gains tax. This strategy goes by several names in different contexts. Buy, borrow, die is the most colorful, and it is legal, widely practiced, and virtually unknown to ordinary investors. The die part of buy, borrow, die refers to the step-up in cost basis that occurs at death in the United States tax code. When you die, your heirs inherit your assets at their current market value, not the price you originally paid. The embedded capital gain simply disappears for tax purposes. So the playbook is, buy an appreciating asset, borrow against it rather than selling it, live on the loan proceeds, die with the asset, and pass it to your heirs with the cost basis stepped up to current value. The family has accessed the wealth during life. The family receives the asset at death without the capital gains tax liability. And the loan? It is repaid from the estate, often from the cash flow of the very asset it helped finance. This is not a loophole in the sense of a technicality that might be closed tomorrow. It is a structural feature of the tax code that has existed for generations, and that wealthy families have used with their teams of lawyers and accountants as a cornerstone of estate planning. Now a note of honesty here. The buy, borrow, die strategy requires certain conditions to work as described. A liquid asset that a bank will accept as collateral, a sufficiently low margin loan rate, an asset that generates sufficient income to service the debt, and for the step-up basis current U.S. tax law, which is periodically subject to political pressure for reform. It also requires discipline. Borrowing against a rising asset is intoxicating. If the asset falls sharply, the bank will issue a margin call, a demand that you either deposit more collateral or repay part of the loan immediately. If you cannot meet the margin call, the bank sells your asset for you, potentially at the worst possible moment. Old money is disciplined about this. They borrow conservatively against their holdings. They maintain cash reserves. They do not borrow to the hilt just because the bank will lend them more. But the principle using debt to defer, reduce, or eliminate tax on appreciated assets is one of the most important weapons in the old money financial arsenal, and it is available to anyone who understands it and uses it responsibly. The insurance angle, debt, life insurance, and the infinite banking concept. There is another dimension to the old money relationship with debt that takes us into territory that even financially sophisticated viewers may not have encountered: the use of life insurance as a private banking vehicle. Wealthy families, particularly in the United States, but also in parts of Europe, have for generations used a specific type of life insurance policy called whole life or permanent life insurance, not primarily for its death benefit, but for the financial characteristics of the cash value it accumulates. Here's how this works. A whole life policy accumulates a guaranteed cash value over time separate from the death benefit that grows tax-deferred. The policyholder can borrow against this cash value at any time, for any purpose, from the insurance company. The loan bears interest, typically modest, but crucially, the cash value continues to grow as if the loan had not been taken. You are borrowing money that is simultaneously still earning a return for you. You are using money twice. This concept, sometimes called infinite banking or the bank on yourself strategy, was not invented by modern financial gurus. Wealthy families have used it for over a century. The Rockefellers reportedly were proponents. Corporate America uses it routinely. It is called COLI, corporate-owned life insurance, and it sits on the balance sheets of many of America's largest companies as a tax-advantaged asset. The appeal is multiple. First, the cash value grows tax-deferred, meaning you pay no tax on the annual growth. Second, loans against the policy are not taxable income you receive cash without a tax event. Third, the death benefit passes to heirs income tax-free in most cases. Fourth, the policy is often protected from creditors in many U.S. states, meaning it is an asset that cannot be seized in a bankruptcy or lawsuit. Fifth, and this is the one that old money truly appreciates, it provides a private pool of capital that the family controls, completely outside the traditional banking system, from which they can finance investments, bridge cash flow gaps, or simply maintain liquidity without involving outside lenders. The family is, in effect, acting as its own bank. The discipline that requires the need to repay your own loans, to maintain the policy, to think in decades rather than years is entirely consistent with the old money mindset. The Rothschild principle. Being the bank. We have spoken extensively about how old money uses debt, how they borrow strategically, leverage conservatively, and structure debt to maximize tax efficiency. But there is a final and perhaps most powerful dimension of the old money relationship with debt that we have not yet fully addressed. The most sophisticated old money families do not merely use debt well. They provide debt to others. They are, in various forms, on the lending side of the transaction. The The Rothschild family understood this 200 years ago. Mayer Amschel Rothschild, the family patriarch, built his initial fortune not through industry or trade, but through banking, specifically through money changing and lending to the German nobility. His 5 sons, dispatched to London, Paris, Frankfurt, Vienna, and Naples, built one of the most powerful banking networks in history. The Rothschilds financed the Duke of Wellington's Peninsular Campaign. They financed the British government's purchase of the Suez Canal. They financed sovereign governments across Europe and beyond. The interest they collected, the fees they earned, compounded across generations into one of the most enduring fortunes in history. But here is the key insight. By being the lender, the Rothschilds were not subject to the risks that their borrowers faced. If a government defaulted, that was a problem. But governments rarely default entirely, and the Rothschilds became expert at structuring sovereign loans with sufficient security and charging sufficient premiums for risky loans that the family's overall return was both handsome and relatively stable. The modern descendants of this strategy are everywhere, once you know what to look for. Family offices, the private investment vehicles through which ultra-high net worth families manage their wealth, frequently allocate capital to private credit. Private credit means lending money directly to businesses or real estate developers, typically at rates well above what a bank would offer, in exchange for which the family office earns handsome, contractually guaranteed interest income. They are acting, in essence, as a private bank. Private equity firms, many of which were founded by or are substantially owned by old money families, routinely use leveraged buyouts. They borrow large sums from banks to purchase companies, use the company's own cash flow to service the debt, improve the business, and sell it years later for a multiple of their original equity investment. The debt is borrowed in the name of the company being purchased. The old money family contributes a fraction of the total purchase price as equity, say, 30%. The remaining 70% is debt, serviced by the business itself. The family earns returns on the full 100% of value creation while having risked only 30%. This is leverage deployed with institutional sophistication, and it has made the families behind the great private equity firms, the Blackstones, the KKRs, the Apollos, some of the wealthiest dynasties of the modern era. Why most people get this wrong, the psychological trap. We have now laid out, in considerable detail, the mechanics of how old money uses debt as a wealth lever. Before we conclude, we need to address the most important question of all. Why don't most people do this? It is not primarily a matter of access. Yes, some of these strategies margin loans against large stock portfolios, whole life insurance at meaningful scale. Private credit investments require a minimum level of existing wealth to execute. That is true. But the foundational discipline, only borrow to acquire income-producing assets, is available to virtually anyone with a credit history. A mortgage on a rental property, a small business loan for a business with positive cash flow, a home equity line used to fund an investment, not a kitchen renovation. The knowledge is not secret. The instruments are not restricted. So why do most people still use debt for consumption instead of acquisition? The answer lies in psychology specifically, in the extraordinary success of the consumer credit industry at reshaping human behavior over the last century. Before the 1920s, consumer credit was rare and socially stigmatized in most Western cultures. Borrowing for personal consumption was considered imprudent at best, shameful at worst. The virtue of thrift, of living within your means, was genuinely widespread. Then something changed. The post-World War I. American economy had enormous productive capacity factories that had produced weapons and military equipment now needed new markets. Henry Ford, Alfred Sloan at General Motors, and others began to offer installment plans, the precursor of modern consumer credit, to allow ordinary Americans to purchase goods they could not afford outright. The psychological key was a simple reframe: monthly payments, not total cost. If a car costs $1,200, a figure that represented months of an average worker's salary in the 1920s, most people could not buy it. But $40 per month felt manageable. And as long as people thought in monthly payments, rather than total cost, they would buy almost anything. This reframe was so successful that it became the foundation of an entire industry. By the 1950s, credit cards were introduced. By the 1980s, they were ubiquitous. By the 2000s, total U.S. consumer debt credit cards, auto loans, student loans, personal loans reached into the trillions of dollars. Every dollar of that debt represents interest income flowing upward to financial institutions. Much of the ownership of those financial institutions ultimately traces back to old money families. This is not a conspiracy theory. It is simply the natural consequence of a system where some people understand how debt works and others do not. The financially sophisticated use debt to acquire assets, including, increasingly, pieces of the very financial system that profits from others' debt. The student loan borrower makes monthly payments to Sallie Mae. Sallie Mae's shareholders, many of whom are institutional investors, managed by, ultimately, wealthy families, receive that interest income as returns on capital. The consumer credit user pays 24% interest on their Visa card. Visa and the issuing bank's shareholders again. Ultimately, institutional capital receive that return. Old money is frequently at multiple removes on the receiving end of the interest that everyone else is paying. The mindset shift: how to start thinking like old money. We began this video by promising that by the end, you would never look at a debt instrument the same way again. We now want to be direct about what a shift in thinking actually looks like. Not for a Rockefeller or a Rothschild, but for an ordinary person beginning to integrate these principles into their financial life. The shift is not about immediately pursuing complex strategies. It is about three fundamental changes in how you think about money. 1. Separate debt by category before you borrow. Before you take on any debt whatsoever, ask one question. Does the asset I am financing with this debt generate income or appreciate in value in a way that is likely to exceed my interest cost? If the answer is yes, the debt may be prudent. If the answer is no, the debt is consumption financing, and you should find another way: save up, delay the purchase, or decide not to make it. This single question, applied rigorously over a lifetime, separates the financial trajectory of the disciplined from the indebted. 2. Think in total cost, not monthly payment. The consumer credit industry trained you to think in monthly payments. Old money thinks in total cost, and crucially in opportunity cost. If you borrow $30,000 at 7% for 5 years to buy a car that depreciates, you are not just paying $5,600 in interest. You are also surrendering the $30,000 you could have invested, or the rental property you could have purchased, or the business you could have seeded. The opportunity cost of that decision compounds over decades. Every time you choose consumer debt, you are implicitly choosing not to deploy that capital more productively. Old money thinks about this constantly. It is why they drive practical cars, live modestly relative to their wealth, and focus their capital, including their borrowed capital, relentlessly on acquiring and growing assets. 3. Build relationships with money before you need it. Old money maintains banking relationships, lines of credit, and liquidity, not because they always need them, but because they might need them at exactly the wrong moment. And having the relationship in place before the crisis is what allows them to move quickly and decisively. Build your credit history with intention. Establish relationships with bankers and lenders before you need capital. Maintain a credit facility, even unused, as insurance against forced selling of assets in a cash crunch. The person who calls their bank the first time when they are in financial distress is in a weak position. The person whose banker calls them with opportunities has built a very different kind of financial life. The next generation, teaching debt to children. One of the most striking differences between old money families and first-generation wealth creators is what they teach their children about money and specifically about debt. Old money families, with rare exceptions, educate their children about the mechanics of capital from a very early age. Not just how to spend money responsibly, though that too, but how money works, how interest compounds, how leverage amplifies, how a balance sheet is structured, how to read a loan document. This education often happens informally through conversations at the dinner table, through being present when adults discuss the family's financial affairs, through being introduced to the family's bankers and accountants as a matter of course. It also happens formally through the structures of the family office, through the family constitution documents that many dynastic families maintain, through the trusts and foundations that require the next generation to engage with financial governance. The children of old money families do not typically arrive at adulthood frightened of debt. They arrive understanding it, its uses, its dangers, its structure, and its potential. They have a framework. They have a vocabulary. They have relationships. Compare this to the financial education received by most people. In school, personal finance, if taught at all, covers budgeting, basic savings, and perhaps compound interest in abstract terms. The emotional relationship most people form with debt is one of fear or shame, something to be minimized, paid off, escaped from. This is not an entirely wrong instinct, given the reality of consumer debt. But it misses the larger picture. It leaves people unable to distinguish between debt that destroys wealth and debt that creates it. It leaves them poorly equipped to evaluate a mortgage, a business loan, a margin facility. The old money advantage is not just financial. It is epistemic. They simply know more and have known it for longer about how the system works. The good news is that this knowledge is transmissible. It can be learned. It can be taught to your own children. The principles in this video, borrowed from centuries of practice by the most financially successful families in history, are available to anyone willing to think carefully and act with discipline. The dangers when the lever breaks. No honest treatment of debt as a wealth lever can conclude without examining what happens when the lever breaks. Because it does break, and when it breaks catastrophically. The history of great fortunes destroyed by over-leveraging is as long and instructive as the history of fortunes built by disciplined leverage. Let us spend a few minutes with the cautionary tales, because they are as important as the success stories. The Vanderbilts, the limits of consumption. We have spoken admiringly in this video about the Vanderbilt family's early use of debt as a lever. But the later history of the family is a cautionary tale of a different kind. By the time of Cornelius Vanderbilt's death in 1877, the family fortune was the largest private fortune in American history. By 1973, not a single Vanderbilt could be called wealthy. One of the greatest fortunes ever assembled had been dissipated in less than a century. The mechanism, not debt primarily, but the consumption mentality that eventually infected the family. The great Newport mansions, the Breakers, Marble House, Rosecliff were not investments. They were monuments to conspicuous consumption, built with capital that was spent rather than deployed. The running costs of these estates absorbed income that could have been compounded. The family divided and subdivided without the institutional structures, the trusts, the family office, the governance mechanisms that might have preserved collective wealth. The lesson? Even a fortune built on sound financial principles can be destroyed when the discipline breaks down, when the lever of debt is replaced by the habit of consumption. The 2008 crisis, when leverage meets illiquidity. The financial crisis of 2008 was at its core a leverage crisis, and it destroyed not only new money, but the carefully built wealth of many sophisticated investors. The mechanism was straightforward in retrospect. Financial institutions had borrowed enormous amounts of short-term money to invest in long-term mortgage-backed securities. This was the duration mismatch we discussed earlier, short-term debt financing long-term assets. When the value of those securities fell, lenders demanded repayment. The institutions could not sell the long-term assets quickly enough or at high enough prices to repay the short-term debt. Many investors outside the banking system made a parallel error. They had borrowed against real estate sometimes at 90% or 95% LTV, in the belief that property values could only rise. When values fell 20 to 30%, their equity was wiped out. When banks withdrew their credit facilities, they faced forced sales. When they could not service their debt from falling rental income, they faced foreclosure. The families that survived with their wealth substantially intact were, almost without exception, those that had followed the conservative principles we have described: modest LTV ratios, long-term fixed-rate debt, strong cash reserves, assets that produce genuine income even in a downturn. Patience and conservatism, not cleverness or complexity, were what separated the survivors from the casualties. The ultimate lesson. We began this journey in the library of a great house, with a man signing a loan document. Let us return there now and see that moment differently. What he is signing is not a burden. It is a bridge between the assets he holds today and the larger, more productive capital base he will hold tomorrow. A bridge between the present and a future he is actively constructing, not just for himself, but for the children who will inherit this house, these accounts, these relationships, this knowledge. Old money's relationship with debt is ultimately a relationship with time. They borrow to buy time to avoid forced sales, to bridge cash flow gaps, to preserve assets through cycles. They borrow to buy assets that compound through time, real estate, businesses, equity stakes that grow decade after decade. They structure their debt to survive time with conservative leverage, match durations, and patient capital that does not need to be repaid at the worst possible moment. And they transmit this knowledge across time to the next generation and the generation after that, so that the wisdom accumulated through centuries of financial experience is not lost with the passing of any single individual. The people drowning in debt are not less intelligent. They are not less hardworking. They are not less deserving. They are simply operating with a different understanding of what debt is, an understanding that was sold to them by an industry that profits from their misunderstanding. The knowledge we have shared today is not new. It is not secret. It has been sitting in the balance sheets and trust documents and private banking conversations of wealthy families for centuries. It is available to anyone willing to think differently. The question is not whether you can afford to understand this. The question is whether you can afford not to. Thank you for spending this time with Old Money Opulence. If this video has shifted something in the way you think about debt, about leverage, about the invisible financial architecture that separates those who build wealth from those who merely earn it, please like this video and share it with someone who needs to hear it. Subscribe if you haven't already. Because this is only the beginning. In our next video, we go even deeper into the world of family trusts, dynasty funds, and the legal structures that old money families use to protect and perpetuate their wealth across generations. You will not want to miss it. Until then, stay curious, stay patient, think in decades.